and welcome. This is Bloomberg Quint, and on the sidelines of the JPMorgan conference, I am in conversation with Viju George, who looks very closely at the technology and the telecommunications sector. Viju, thanks for joining in and taking the time out. Let me begin by asking you about the information technology sector, and perhaps I can specifically talk about the large cap stocks here. Now, there is some amount of evidence, perhaps an argument being built that while the economy's growth has come off to a certain extent, you do have some of your large cap names which are likely to show growth of as much as double digits, some of them higher than that. The real question here is that a good enough argument to perhaps move into some of these companies, and how are you reading into growth in general based on the trends that you've seen and, well, the kind of conversations that you're having with the managements of these companies?
Sure, Agam. Thanks for having me. I think it's really a mixed picture. There are a couple of names under the large cap category which are going double digit or near double digit, but there are 2-3 other companies as well which probably will struggle to reach more than mid-single digit as well. So there isn't a consistent pattern of growth. That's one. Secondly, 8 to 10% growth in constant currency organic terms is good growth in this environment. In the context of issues that we are having in elsewhere in the Indian economy, this is seen as a defensive hiding place, if you will, for investors. And I think the stocks and the valuations for a couple of names do reflect that. But I think the focus for us should really be on what the growth for next year is likely to be. What are the incremental growth trends? And from there, we don't get too much comfort from the overall macro data points, which suggest that clients may alter the pace of spending on technology if they see sluggish demand at their end. So I guess that's the more important question, and therefore I expect that growth rates might start to moderate next year onwards, that is FY21, which may not be completely built in the valuations of some of the large cap names, particularly those which have crossed 20 times forward. What gets built in really is a defensiveness in these times.
All right. Well, some very interesting points made out there, Viju, because that actually leads me on to my next question. That is to do with the kind of deals that some of these large cap companies have signed. Again, I'm just sticking to the large cap names for now. What is the nature of these deals? And while some may argue that while the deal sizes have been increasing, the time frame for some of these contracts has been, well, becoming shorter and shorter in terms and the time spans. So what is your observation here, and is this also a matter of concern?
So it depends on what you define as a large deal. A large deal can be a lumpy deal. And if you're talking about very large deals, typically, $250 million plus total contract value or TCV, these kind of deals tend to be lumpy, and therefore there's no steady pattern to those deals. And therefore, there I think is that you should not extrapolate what has happened in the past to the present, because that's a very client-specific situation. So TCS had, 4 or 5 of these mega deals, which gave them $5 to $6 billion in total contract value in a particular couple of quarters itself. I don't think in this year they won, some of deals to that magnitude. So I guess they're lumpy in that sense. Now, as to your second question, that the deal sizes are increasing, that's probably true more on the digital side. And that, I think, is just an indication of the maturity of the digital ecosystem and the fact that clients are more comfortable committing to larger digital programs. They're not legacy programs. So there the sizes are increasing, and the duration is also increasing. So I guess you are having a combination of 2 factors: the large legacy lumpy IMS or multi-segment deals are not coming through as much today versus 6-9 months back. But at the same time, the digital programs of a small base are getting larger in size. Now, I don't know whether the digital growing maturity in digital space will be enough to offset, maybe the lack of deals or the lack of large deals in the legacy space.
Okay, Viju, I just need a confirmation, perhaps a clarification here. While we are expecting near double-digit growth for some of these companies in FY20, the suggestion here is that those growth rates may not be the same and could actually be lower in FY21. Could you elaborate a little more on that as to the reasons behind that? You already alluded to a certain extent that there has been slackness in client spending. Can you tell us a little more about this?
So I think I'm just looking at the global macro data points. I think it's a given that the global growth is slowing. And if the US economy also slows down incrementally, as seems to be the opinion, recession or no recession, I think it will play through IT services spends. That's one. Secondly, I think within the capital market segments, we are already seeing increasing murmurs of cutback or moderation in spending. Some of the large caps do have reasonable exposure to the capital market segment, so it should tell on that commentary as well. And third, this may translate to certain other sectors like retail, where consumer spending may not hold up, or in manufacturing, where capex may not hold up. Right now, this is a very client-specific phenomenon within these two verticals, but you cannot rule it out being a little bit more broad-based as we go into next year. I don't think it's anybody's case that growth will crater or collapse. It's just that growth is likely to moderate. At this point in time, probably 200 basis points, 200, 250 basis points from FY20 growth. FY20 growth, mind you, is also largely in the bag, probably because you had good deal signings coming into FY20. So it's important to be able to exit with similar deal signings in FY21 to get growth there, which I'm not sure is completely happening.
Viju, how are you going about picking out some of these companies or ideas in the mid-cap space? What are you looking out for? What are you keeping an eye on?
See, firstly, you need the comfort of valuations. You need the margin of safety there. So I really would not want to go for mid-caps which are priced well above 15 times one-year forward earnings. 15 times and below is what I prefer to look at. Secondly, mid-caps typically have large-sized exposure to clients, specific clients. They have client concentration issues. And if a client is pausing on spending, then it shows up in growth as well. So you need to sort of make sure that the mid-cap in question does not suffer from acute client concentration issues, which can impact growth if the client stops spending or if the client moderates its spending. And third, you also need to be wary about the margins profile as well of mid-caps. It's far more volatile. So if mid-caps tend to suffer H1B pressures more acutely than some of its counterparts, it tells on their already thinner margin profile, and therefore impact to profits is even higher. So these are the three things that you look out for. On the fourth side, we would look at to see if mid-caps continue to disrupt a space, like certain companies like Hexavan may have disrupted the IMS space using automation as an entry point. Or Mindtree may have used digital marketing as an entry point for on the digital side. You'd have to see if they're able to, if spending around these teams continues to be robust, so that the bread and butter businesses of such mid-caps does not get disrupted or does not get affected.
Okay, Viju, so finally, when it comes to at least the IT space, the question on margins. Now, on one hand, you do have a lot of global volatility, which is, of course, bearing down on the rupee. Of course, our own weak macros don't exactly help the Indian rupee, which means that the US dollar is expected to, well, I would say remain steady and stronger in general overall. But on the other hand, there's the other aspect of people's costs increasing, subcontractor costs increasing for a lot of these companies, and you've already made a mention of, ever rising, visa costs as well. How do you take all these factors into consideration, and what are your expectations when it comes to operational profitability for the sector?
Yeah, so I think you have to look at this at the current rupee dollar rates at 72. I think we will be hard pressed to hold margins into the next year, because what typically happens is that as clients also feel pangs of a slowdown, they're ready to transmit those pressures to the vendors as well and exercise pricing tightness. So I think being vendors likes of Infosys, TCS, etc., will not be able to escape that pricing pressure. And coupled with rising costs, I think the margins will have to trend down ex currency. But if the rupee were to depreciate from 72 to maybe 75, so it's another 5-7% from here, obviously over the next 6 to 12 months the margins would hold up. Though over time, typically within 3-4 quarters, we have seen that the margins tend to be given back to clients. The benefits of weaker currency tend to be given back to clients. So that can't be an enduring lever. At all. It might be a near-term margin protection, but ex-currency, I do feel that the margins of some of the large caps will moderate going forward.
Okay, right, Viju. So then let me shift focus to the telecommunications sector. This is perhaps to do with the more recent developments with respect to broadband. And Reliance Jio, of course, has made public the plans that they have as far as their broadband plans are concerned. But these plans are not perceived as very aggressive. So if you go by that perception, why is it that the pricing that Jio has chosen is not that aggressive? What could be the reason behind it, and how are you viewing the latest developments when it comes to these announcements?
Yeah, so I think Jio is obviously giving you a very bundled offering out there in broadband, right? It's not just broadband; it's broadband, TV, content, everything put together, together with a set-top box, etc. So I think what they're seeing is they're looking for customers with the willingness and the ability to pay, and maybe the focus is on finding the first, 2 to 5 million subscribers, on that basis. So the pricing obviously came as a little bit of a pleasant surprise to us, in the sense it was not, like mobile pricing, but if you see, they're not looking to get 300-400 million subs immediately here, like they've gotten in the telco space. Secondly, you have to understand that here the largest player is a state-owned player, where the service levels sometimes leave much to be desired. So there isn't too much of an entrenched competition, unlike in wireless, where you already had an entrenched competition by way of the big three then, which is Bharti, Vodafone, and Idea, and a host of smaller players. So you don't necessarily have to fight for market share against entrenched players for which you to bring your pricing down. Jio is looking to expand, cultivate and expand a big market by itself. It's doing that on the basis of value and not on pricing, because the market is still quite nascent for broadband, as it believes, unlike in the wireless space, which is already crowded. So I think these are the two factors that make us feel that you really don't need to disrupt the market to get entry here.
Okay, a final question then. Do you think that plans from Reliance Jio that will be introduced will expand the broadband market, which has been relatively stagnant over the last couple of years?
Yes, I think Jio is also conscious about not wanting to cannibalize its wireless base, right? Because if you were to introduce plans at 200 or 300 rupees, for an example, I could jolly well just stick to the mobile piece, which at 100, 150 rupees a month, effective ARPU, where I'm getting more than 1 GB a day. So I think, at some point they are trying to expand the broadband market, because if they were trying to price it too aggressively, then it would take away subscribers from from their base business as well. So here they're trying to avoid cannibalization, and that's why the pricing is constructive. Secondly, I think there is enough of a population that I can't quantify it at this point in time, but if I have to make a wild guess, maybe 3 to 5 million who can afford to pay 700, 800 plus, for a unified package. Jio is probably trying to tap into the discontent that such consumers experience, and that is why when I say that more than 50% of the broadband subscriber share is held by the state-owned providers, there is discontent there that Jio is trying to tap into. These subscribers still pay 500, 550 rupees on average. So I think they are trying to both tap into discontent of the existing discontent that people feel with the existing service provider, as well as get that 5 to 10 million subscribers in the bag who can afford to pay more. So it's both creation of a new market as well as taking away share from players from well-to-do subscribers who can pay that much.
Okay, well, Viju, we leave it at that. Thank you so much for joining us and taking us through your views on both these very important sectors. Thank you very much.
Attractive term